Hello and welcome. This is our third conversation with Sanjay Chawla in the past 2.5, 3 years. He's CIO-Equity at Baroda BNP Paribas Mutual Fund. As Indian markets try to regain their footing after last year's correction, fresh geopolitical jitters and valuation concerns have made investors cautious again. So, in this chat, Sanjay will walk us through how his funds have performed, how he's sizing up mid cap stocks, and if today's stretched valuations have him worried. Welcome, Sanjay.
Thank you so much, and always happy to be back again conversing with our investors and your listeners.
First up, Sanjay, how are you reading the Indian markets right now? With the recent bounce back, do you think the correction phase from late 2024 is already behind us?
So, I think I would like to take you back to about 18 months back, sometime in Jan of beginning of the last calendar year, when the elections were announced, and we did feel that during election phase and post the formation of the ministry, there's always going to be a lull in terms of capex spending. Uh, in between, while the elections outcome happened, the ministries were formed. We were actually hit by a prolonged deep summer wave, which impacted the demand outlook per se. Unfortunately, post the ministry formation, we'd seen a lull in the capex spending, and this actually impacted the overall earnings growth per se. So earnings which were projected to grow for FY25 at anything between 12 to 14% have actually tapered down to a mid low single digit out there. We had to close the financial year, but that has impacted out there. Post that, we'd seen a new president coming through at the White House. And subsequently, he had announced his own agenda in terms of protecting his own economy by imposing tariff again, which meant that there was a significant impact in the global trade. How does it impact India per se? I think on a relative basis, we are better off, but it does mean that the global trades would get impacted. And that's how I see the entire equity market has reacted to what has actually happened in the last 18 months. The good part is, do we see this earnings growth slowing down as a cyclical, or is it structural? I think it's a cyclical thing because of certain events which have actually panned out. And I do think that the earnings will come back out there.
Sir, when do you anticipate a full recovery in the Indian equity markets, particularly for the small and mid cap segments, which had taken a huge beating compared to the large cap peers?
So it's a very interesting question, and this is something that we keep debating internally. Uh, there are certain external factors that you have to be mindful of. And when you say that when the recovery would happen, it is dependent on you actually talk about the stock market prices out there. We go down a little deeper. What are the factors which impact the small cap and the mid cap? The immediate thing which comes to our mind is, of course, the earning numbers. And I think that's the key determinant. But there are certain other softer aspects also which determine how are the mid caps going to be performing. Uh, Typically, we've seen when the economy is slowing down, and mind you, I'm saying slowing down, I'm not saying a degrowth. That's when typically the mid cap and in particular the small caps get impacted. There's lesser interest out there. And that's something which we continue to see out there. I would tend to believe that the last 3 years rally in this space was partly liquidity driven, where we had seen significant flows coming through in this segment. If I drill down as an analyst and look at the earnings numbers, I think the small cap has slowed down a lot more than what the mid cap has, and mid cap has slowed a little faster than the large cap. So while we spoke of the earnings growth for the market coming down to a low single digit, we need to see what was the historical trend. The historical trend for the large cap was between 14 to 16%. It slowed down. The historical trend, I'm talking about last 3 to 6 quarters, mid cap was averaging about 26%. Okay, and the small cap was averaging about 30%. Okay, quarter after quarter. If that is coming down to zero, which is, I mean, it's not exactly zero, it's a very, very low single digit. The decline in the earnings for mid and the small cap has been far more faster than what we've seen for the large cap. Uh, do I see the recovery happening for the mid and the small cap? We're seeing pockets of recovery happening in the mid cap. Uh, it's a little too early to call it at an index level to say that the recovery is there, but can I identify 10, 15 companies in the mid cap space which is looking attractive? Yes, I do find it out there, but I think it is a little time away in terms of calling a complete recovery in that space from an index level.
So, if you could share, what are the biggest risks to the Indian equity markets in 2025, particularly in the light of geopolitical tensions and higher valuations in certain pockets?
So I think you nailed most of the factors. I think we are amongst a heightened security risk with our neighboring countries. And unfortunately, we are surrounded by, especially on the northern side. In fact, you have three fronts which have actually opened up. Earlier, we had just absolute north of India. Now, on the west of India as well as on the east of India, we've had three countries which are not so friendly, and that's something which one will have to be mindful of. Uh, Earlier, even in the south, we had a challenge, and of late, we've done what we had to do to ensure that we have a cordial relationship. It's very important that you are surrounded by not so challenging people, because then your entire attention and focus is driven on economy and on the welfare side. So to that extent, I would say that that continues to be a risk. Spreading it further, the Middle East continues to simmer once in a while. Uh, Russia, Ukraine also once in a while tends to explode or implode, whichever way. But directionally, I would believe that those things are coming down in terms of intensity. My bigger worry is in terms of the global trade. So, any impact of the war is more on the supply chain side. I think that's something that we need to keep in mind. When the Middle East war took place, we had seen a significant disruption and the freight rates going up. When the Russia-Ukraine thing happened, we had seen a significant disruption in terms of the agri-commodities and certain key inputs which they were doing. I think the generalized higher tariff in the world would mean that the overall GDP is slowing down. Okay. No matter how much I would say that India is insulated, to some extent, its own GDP could be shaved off to that extent. My bigger worry is on the second derivative of the global slowdown, which could mean that what happens to the IT sector, which is external facing. My third derivative would be what happens to the overall global flows. And I think that's a very key component in any emerging market, including India, that they need capital for growth. So those are the things that I keep worrying about. I don't think I'm too worried or fussed about the Indian economy. I'm not too worried about the earnings growth. Can it get impacted because of these factors? Yes, we are monitoring them very closely.
Now, so coming to the investment strategy, your team follows a BMP approach, as you mentioned earlier with us, business management and valuation. How are you applying this in the lens in today's volatile environment?
So that's a very interesting question. And the good part about this BMV framework is it's not really related to a particular situation. It can be applied at all times, whether it's volatile, steady. In volatile times, as long as the businesses are good, the management are reasonably okay, the valuations is what will actually make you see saner things in terms of how they're panning out. Even in the valuations, when we are talking about, we follow a growth-oriented approach. We call what we call the GARP philosophy, growth at a reasonable valuation. We will look at companies which are growing and are available at a reasonable valuation. So there's an art and science because the science part is predicting the growth. The art part is whether this is the right price that you would pay for this kind of a growth or no. So it actually helps us to stay saner despite whatever meltdown is actually happening and whatever volatility is happening. Let me flip the argument. Uh, when the markets were at the peak, what actually helped us was the same philosophy because the moment you start focusing on the valuations, then you realize that it's really not worth it. And that's how we tend to navigate not only through volatile times, but during uh, exuberance also.
How many stocks do you actively track and consider as part of your potential investment universe?
So we have a concept of what we call as a minimum threshold in terms of market capitalization, and it's a moving target because if the index moves up and down, so we look at whichever is the last company of BSE 500 or NSE 500 as a cutoff, which would mean that you'll have about 1,000 companies in the investable universe. We've taken approximately 50% of them in our investment universe. Okay. Uh, we believe that on an average, an analyst can track 25 to 45 companies. And effectively, we do a very good job in terms of tracking those companies. While our actual portfolio will have about 150 unique names across the various 150 to 175 unique names. And the tracking for those 150 to 175 would be a lot more aggressive.
We spoke about how do you buy the stocks in your investment framework. What are the top three reasons that typically prompt you to sell or reduce the exposure in the company?
Oh, usually the biggest reason is I need funding for some other stock, and then I evaluate which is the least performing or likely to be the least performing one. We constantly evaluating ideas, and we see what is the potential return a particular stock can give compared to what I already have. So if I have a stock A which is expected to give 12% and as part of my portfolio, and I discover that stock B can give me a much better return with a lower risk, I would ideally like to substitute stock A with the new stock. And that's the most frequent reason why we look at it. Once in a while, we feel that the company's reached its valuation or it's overstretched now, and there's a potential of generating a negative return. I would say that's the second most frequent reason. In the last 3 years, we found only one reason where things have really gone wrong from on the corporate governance side, and we needed to sell down. So at that time, it doesn't matter. We just sell.
Right now, moving on to some fund specific questions. So, your FlexiCap fund has trailed its benchmark and peers over the last year. So, what went wrong there, and what adjustments are you making to improve its performance now?
So I think it's a unique category, FlexiCap, because you allow the fund manager to decide how you want to position yourself in terms of the market capitalization. We were running a strategy where we were a little over leveraged in the mid and the small cap. So if you look at the performance of the mid and the small cap in the last, I would say now for almost a year, the small cap and mid cap have actually underperformed very significantly. And the underperformance has come especially in the Jan-Feb-March quarter, where the underlying index has fallen by about 15 to 18%. Just don't hold me for that number, but that's the magnitude I remember broadly, versus the large cap, which is down by maybe low single digit number. The way we were positioned was we had an almost equal weight to large cap versus the mid and the small cap. And when you compare it with the index, NSE 500, 78% is large cap. So obviously, when you have such a huge variation, you will get impacted. Our ability to predict these external events in terms of tariffs, etc., is something that at times beyond us. We can very accurately predict what are the earnings and the way it should do. Uh, I have two learnings in the last 34 years. Never ever predict the election results. And the second one is never try to second guess a politician's economic policy. A lot of times they're not rational, but they run through it. So you need to react to that rather than saying that this should not have happened. So what has actually happened in JFM, Jan, Feb, March, is more of a sharp downturn. And historically, we've seen our ability to predict such downturns, which are beyond fundamental reasons, is very low. Uh, while we have underperformed in the short period of time, but we've held on to the names that we like, because all I need to know is the small cap and the mid cap companies that I have, are they fundamentally strong and they've come back. Well, we do get impacted by the downfall. We use this opportunity to reshuffle the overall portfolio in some stocks. But do I change the entire style that I have? No, we don't. We continue to be more bottoms up. Uh, Maybe there's some bit of increase in the large cap exposure because of the stability that we want to provide. Maybe the small caps have gone a little lower, but by and large, we continue to believe that what strategy we have been running is very effective. And just to put it in perspective, while the last 3 months have impacted us, but if we had the same conversation in December, I think it would have been a fairly different conversation, because this fund was doing very well.
Yes, absolutely. Sir, again, coming to the multi-cap fund, which has done very well in 2024, but in the 2025 period, it has again struggled. So is it the same reason as you mentioned about Flexi cap, or is there any other reason in the multi-cap fund?
So I think it's a little unfair to just compare 4 5 months for an equity fund, and there could be specific stock names which have not worked in the short period, and they bounce back, and that's the way I'm really looking at it right now on the multi-cap space. So multi-cap, of course, everybody's boxed in with 25 mid in the small cap, and it would have impacted everybody. Maybe a little more for us and maybe a little less for some of them. As long as you have fundamentally good stories, good stock, the performance will come back. And I am actually seeing the performance coming back as we speak. So last month or so, I think a lot of clawback in terms of performance has actually happened. Maybe it's not really impacted the full year performance, but I think strategy-wise, it's similar on the same lines.
Okay. No, sir, the idea was to just to understand if some funds are not performing well. You are not worried about the quality of the portfolio. It remains strong, and it was just a matter of market conditions where, where we saw some correction, and then again, it's back to the basics kind of thing.
Absolutely. So I'm with you on that. Yes, there has been an impact, and I would agree. And this is something that we monitor very closely. So, what has gone wrong? What is the learning that we've had? Uh, should we be doing a course correction? Should we be sticking to what we are doing? But I think it's a mixed bag, I would say. We are doing course correction in some of the names. We continue to stick to what we like. Maybe it throws up a very interesting opportunities to add more of it.
Right. And the balanced advantage fund also, it had a solid 3 and 5 year numbers, but is in third quartile over the last year. So what held that back, and what steps are you taking? Any steps to regain that edge?
Again, the BAF or the Balance Advantage Fund is a slightly different reason. While in case of FlexiCap, and I would say in the mid and the multi-cap, it was more on the mid and the small cap exposure. In a Balance Advantage Fund, we have a model-driven asset allocation plan. Where the investment manager doesn't determine what should be the net equity allocation. So if you look at the net equity allocation of the category versus what our model suggested and which is what we follow, we are far higher than the peer category by almost 20%. So while the peers anywhere between 50 to 55%, we've averaged about 65, and right now it's about 75%. Typically, when the equity market comes off, your performance will get impacted in the shorter period of time. And again, if I look at the performance till December, it held on well. And the gap in the category average is so less that a one quarter underperformance by a very large percentage can actually impact you very significantly. And that's what we've seen. Have we changed that thought process on the net equity? It's something that we have tested it out over a period of time. We did a back testing for almost 12 years. We have live data for the last 5.5 years. I don't think we're changing the model because we have solid history. Have I seen this kind of an underperformance in the past 5.5 years? We've seen it twice. The last one being when Russia-Ukraine war actually happened, where we had a very solid track record. The 3 month the markets came off, this fund underperformed for maybe 3-4 months, and then it came back very strongly. So we do believe that we have a solid story out there in terms of the long-term performance, backed by past track record as well as backtesting of the data. And it's something which has been a very consistent performer. I do believe that because there are fundamental factors for this net equity allocation model, ultimately that will prevail.
Fair.
If you look at the large and mid cap fund, flexi cap fund, and even the ELSS fund, they have high mid cap exposure. So, what keeps you confident in that space despite the high valuations?
So there are two things. Of course, mid cap went through a cyclical slowdown because of, as I mentioned, that I think liquidity in the corporate system was a little lower, which actually impacted. I believe this is my learning from managing mid cap funds, etc. They tend to impact the performance, the corporate performance of them. Things have eased off post that. The best part is if you look at the quartile numbers for the quarter ending December, at the index level, if you look at NSE 500 and look at the mid cap stocks, the earnings came back very strongly out there. So that was the biggest surprise for us. Okay, so I do believe that mid caps are the ones which can be a very interesting play, and this is something that we are watching out for the March ending quarter. Having said that, in all these three funds, what we need to look and identify is maybe 15 mid-cap stocks, which are doing much better than our expectation. And assuming that you have a 2% weight on an average, that takes care of the entire holding that we have in the mid-cap in all the three categories. So, as I said, we are watching the mid-cap space very closely. The valuations are, yes, I think valuations have to be seen in conjugation with the growth numbers. If the growth comes back, you can justify the valuation. If the growth doesn't come back, then we can have the same conversation next time that yes, the valuations are expensive. Uh, but we're using a bottoms up approach in these places. And for us to identify for the fund size that we are running, 15, 20 names, mid cap space, which fit into our investment framework of BMV is not at all difficult.
Moving to the focused fund, with its concentrated portfolio, it has underperformed significantly over the last year. So, how do you balance growth and value styles in this fund to navigate such challenging periods? And are you making any adjustments to improve the performance going forward?
Sure. So you're right. I mean, the focus fund is something which is more of a bottoms up, and I cannot even defend it by saying it was a mid cap or a small cap. Uh, I think the concentrated strategy, and we were running a super concentrated strategy compared to the peers, has not worked. So the first thing that we did is we changed the underlying attribute of the fund, where we said that we are expanding that list from 25 to 30 stocks, which is aligned to what the peers are doing. And post that, I think we've seen a significant improvement out there compared to our own expectation. Uh, yes, typically when you are having a 25 stock, which would mean that your minimum weight would be 4%. Okay. And if two stocks go wrong, that actually impacts the performance very significantly. And that's exactly what had actually happened out there in that segment. So there were two stocks which got impacted, and that's how the performance has got impacted. So what we identified is maybe we need to diversify in terms of the holding, and that's what we've done. We've taken corrective actions. It was a fundamental attribute change. We gave the exit option. There was no outflows, and people have stuck to it. We've seen improvement happening on the margin. Can I say we are completely out of the woods? Give me another month or two, and I think you will see the performance, even on a 1 year basis and a 2 year basis, coming back very strongly. So, if we cut the chase to last year, same time, 1 year back, it was doing very well. And it was outperforming the benchmark and the peers. The same thing was there. The reason why we did well was because we had a very concentrated portfolio and the things worked very well. So I think it's more to do with our ability to manage that risk. And we realize that we need to diversify it a little more in order to make the whole thing work. So earlier we thought we could get away with 20 to 22 names. We realized that's not what is the right strategy, especially during a volatile times, and which is what we witnessed. So if it was a complete bull market, then that strategy would have worked. But we need to protect the investors' interest, and that's what we've taken.
Right.
Sir, you spoke it earlier, but how do you draw a line between the flexi cap and the multi cap categories? They seem similar but follow different rules.
Oh, so this is a category which has been defined by the regulator, and that is well defined. Uh, a multi-cap will have minimum of 25% in small cap, mid cap, and large cap, which would mean that the investment manager has a flexibility only for to the extent of 25%. Okay. We follow a strategy of what we call my fund manager is very fond of football. He calls it 4-3-3 strategy. Okay. So there's a defender, there's a midfielder, and an attacker, and that's the strategy. So we have 40% in large cap, 30% in mid cap, and 30% in small cap. So when I say it adds up to 100, but obviously at times you have some cash. So on a relative basis, that's how you adjust across, and there could be plus minus 1% out there. In case of FlexiCap, we allow the fund manager to determine where they want to be invested in. It could be a call on the cap curve that he or she is excited about, or it could be a bottoms up approach that you actually have. So, right now, if I recollect correctly, we run a 40 sorry, it's a 50-30-15 strategy that we have out there. But when the fund was launched, it was more like 75 and 25. Over a period of time, the mid and the small cap exposure has gone up. Unfortunately, the category in Flexi Cap is more gravitated towards the large cap. If you look at the peer average, it is at about 65 to 60, it's between 65 to 70%. I think over a period of time, you will find our fund making a huge difference in this category in terms of performance.
Now, several of your funds, they hold high PE stocks. The FlexiCap does, ELSS, focused fund as well. So how do you justify that in a cautious market?
So, when we look at any valuations, you have to see it in conjugation with the growth. And we've always chased growth because we believe that growth is what actually generates the return. When we say the markets are expensive at 20 PE, I have no idea whether it's expensive or cheap. I would say that, look, if the growth is 5%, the markets are expensive at 20p. But if the earnings growth are at 15 and 18 and 20%, is 20p expensive? I don't think so. So typically, when you're talking about a high P stock, some of the names that we've identified in their classical turnaround stories, we have a not only the growth numbers are high, but ability to predict over a longer period of time for this kind of growth to sustain in terms of the visibility is also high. The confidence is high and the duration is also high. So we've never hesitated from buying so-called expensive names, provided the visibility is high and the predictability is high.
Sir, suppose if you have high PE stocks and the growth doesn't come for 2-3 quarters, then how do you go about it?
So yes, I mean, as long as the investment thesis is violated, that's when we actually start questioning whether these kind of a P multiple should be given or not given. So we've got a classical retail company, which was I would say a 10 bagger or a 100 bagger since we invested. The growth rates were at 45 to 60% consistently. The growth slows down to 25%. You need to take a call whether the growth rate is 25% is the correct structural growth rate going forward, or is it cyclical? Okay. If 25% is the growth rate, then should you continue to give a 3-digit P multiple or no? And the answer is no. I'm giving a higher multiple for a higher growth rate. So if that comes off, then you need to recalibrate your this thing. So as long as you answer that question, the outcome or your reaction to the stock is quite obvious out there.
So lastly, sir, for the retail investors looking to enter the market now, how would you suggest they allocate across large, mid, and the small caps?
So again, I've always advocated that it depends upon the risk profile of the investor, and that's how you need to allocate. It's also a function of what are your financial goals that you have. If you don't have the ability to take higher volatility impact, whether then you should not be in the small cap. Maybe you may want to look at mid cap. If your requirement or your financial goals are more immediate, then you need to have a lot more calibrated approach by investing in the hybrid funds, which are even less volatile. So I would advocate that, look, depending upon the risk profile, and I keep hearing this question of tell me the best fund that you have. And my answer has always been that, look, all the funds that we have the best resource to manage them. Now tell me, is it matching up to your risk appetite or no? If it is, then it's the best fund. Let's not chase return per se. Let's map up the risk. The returns will follow. There could be a quarter difference out there, but it will eventually come through. I would tend to believe that the way the valuations have stacked up right now, uh, the way there's a lot of uncertainty in the market, we have the geopolitical uncertainty, you also have the tariff uncertainty. It throws up a very interesting opportunity for the retail investors to step in out there and really double up on the investments out there, because I do believe India's economic growth is for real and it's going to be sustained. And I do believe that India's time is now. I think there are a lot of good things going on for the country. I understand. I don't know what's the outcome in terms of retaliation. I have no idea. But do I see that sustaining for the rest of my life? I don't think so. Things cool off. In the last 30, 40 years, we've seen multiple wars, right? Uh, we've seen multiple events which actually happen. But these are the opportunities which throws up very interesting times. And you actually create wealth in a bear market, not in a bull market.
Right. Thank you, Sanjay, for joining in and despite a sore throat, answering all our queries. Thanks a lot.
Thank you.
And to our viewers, let us know what you think or ask questions in the comments below. We'd love to hear from you. Keep watching this space for more information. Thank you. Bye.